Let's explore the differences between two common scenarios in conventional mortgage financing: a 5% down payment and a 20% down payment. We're going to examine how the down payment amount affects the monthly payments, the total interest paid, and the overall affordability using a real-life example. And if you have any questions or comments, please make sure to leave them below and I'll reply personally. So let's start with a 5% down payment conventional mortgage. So we're gonna talk about the pros and the cons like we like to do. So 1, lower initial expense. You need less cash up front, which can be beneficial if you don't have a lot of savings but still wanna purchase soon, right? That's a huge benefit, knowing you can put 5% down and you don't have to be a first-time home buyer to put 5% down. You can have investment diversification. The money you save by not putting down 20% can actually be invested in other areas, which potentially earn you a higher return than it would if you were to put it into the property. There's more accessibility when you can put less money down because it enables first-time home buyers or anyone with limited savings to enter the housing market sooner than they would be able to if they had to try to save up 20%. You also would have emergency fund maintenance. So let's say you do have enough money to put 20% down, but you opt not to. Well, by saving on the down payment, you can retain more of your savings for emergencies. But there, of course, are cons to putting a lower down payment, because with a smaller down payment, your loan amount's larger, which leads to a higher monthly mortgage payment. You would also have to pay PMI, or private mortgage insurance. Typically, this is required for down payments less than 20%, but it's an additional cost until you've reached 20% equity in your home or refinanced once you have 20% equity to eliminate that mortgage insurance. You would also have higher interest costs because over the life of the loan, you're going to pay more interest since you had a larger loan amount. On top of that, you have market risk. If the market dips, you're at a higher risk of owing more than your home is worth due to the smaller equity stake you made up front. So let me give you an example of what a 5% down payment on a conventional loan would look like if you were to buy a home for $400,000. So your purchase price is $400,000. You put down 5% of that amount, which is $20,000, meaning you borrow $380,000. Let's just say the interest rate is a fixed 7% over 30 years. Well, your principal and interest payment on that would be $2,661.21. But on top of that, you'd have mortgage insurance, and I'm using an average here, of about $269.17, making your combined total payment, not including taxes, not including insurance, $2,930.38 per month. Now, over 30 years, assuming your mortgage insurance fell off after 5 years because you had enough equity to have that removed, on your $400,000 mortgage, you would have paid $974,185.80, which is more than double what you originally borrowed. Now let's compare this to buying a home and putting down 20%. Well, let's get into the pros. Lower monthly payments. Because you have a larger down payment, you're going to borrow less money, which means you can have a lower monthly payment. Naturally, you're not going to have to pay PMI or mortgage insurance. You're going to avoid this extra cost because you're putting 20% down on the property and it's not required. You're going to have more equity immediately. A significant down payment will give you a solid equity cushion, which means it's more beneficial during market fluctuations. You're also going to have a competitive advantage. In a seller's market, a higher down payment could make your offer much more attractive to sellers than someone putting less money down. This is typically due to the seller's thought of the property potentially underappraising. Someone having more money going down can cover any sort of gap between that appraised value and the agreed upon purchase price, where someone putting less down may not be in a position to do so. Now let's talk about some of the cons though. Of course, you're gonna have a higher initial cost. You require a larger amount of money up front, which might deplete your savings and delay your ability to buy the home because it takes you more money to buy that property. You're gonna lose opportunity cost. The money used for the down payment could have been invested elsewhere, but you could lose out on opportunity cost because that money used for the down payment could have been invested elsewhere, got you a larger return than what you're really saving on a monthly basis by putting it into your property. You're also gonna have less liquidity. A larger portion of your wealth is tied up in your home, which makes it less accessible in the case of a financial need. And your risk of over-investing in real estate is there when you tie more money up in your property, because with more money tied up in your home, you're more exposed to the risk of the real estate market. Let me give you an example of a $400,000 property putting down 20%, which is $80,000, meaning you're going to borrow $320,000 on that property. Let's use the same 7% 30-year fixed rate that we used in the prior example with 5% down. Well, your monthly principal and interest payments, putting down 20%, are $2,128.97. You don't have mortgage insurance because you're putting 20% down. Over 30 years, you're going to pay $766,428.47. Well, let's compare that to the 5% down option. The monthly payment, putting 20% down versus putting 5% down, is $801 less for the same property. And with 20% down, you're saving almost $208,000 over the 30-year term. So it's a substantial amount of money if you're in a position to put that larger down payment. Now, while a 5% down payment may offer lower upfront costs, it results in higher monthly payments due to the inclusion of the PMI and the larger loan amount, as you've seen. A 20% down payment eliminates that need for mortgage insurance, resulting in a lower monthly payment and significant savings in total interest paid over the life of the loan. Choosing the right down payment amount depends on your financial situation, your goals, and your priorities. Consider consulting with a mortgage advisor to determine the best option for your specific circumstances, and subscribe to this channel for more videos like this one.